3 months ago, my friend Helen called me crying. Not the kind of crying you do when something upsets you for a moment, but the kind of crying that happens when a person realizes they have made a mistake that cannot be undone. Helen is 71 years old. She lost her husband, Robert, 2 years ago after 46 years of marriage, and like most people in that situation, she did the thing that felt natural. She kept their joint bank account open. Closing it felt like closing a chapter of her life she was not ready to close, so she left it as it was and later added her daughter as a joint holder so someone could help her manage the day-to-day finances. It seemed sensible. It seemed safe. Nobody warned her about what would happen next. Centrelink assessed the joint account, saw 2 names attached to it, and counted the entire balance as belonging equally to both holders. Because of how the joint account linking worked, a portion of her daughter's own separate savings was also drawn into the picture. Helen's assessable assets jumped overnight, her pension was reduced, and then came the letter nobody wants to receive, the one telling her she had been overpaid because her asset position had apparently been higher than reported for months. She now owed Centrelink money, on a fixed income, with absolutely no warning it was coming. She called me that afternoon completely devastated, and said, "I did not do anything wrong. I was just trying to manage after Robert died. How did a bank account do this to me?" That question is exactly why I am making this video today, because joint bank accounts are quietly causing financial damage to thousands of Australian seniors who have no idea the rules work this way. Welcome back to my channel. This is Australia Pension Hub, and today we are covering everything you need to know about how Centrelink treats joint bank accounts, the mistakes seniors keep making without realizing it, and the steps you can take right now to make sure your
bank account is not silently undermining your pension. Let us start with how Centrelink actually assesses a joint bank account, because the reality is very different from what most people assume. Whether the account is shared with a spouse, an adult child, a sibling, or anyone else, Centrelink applies one simple default rule. Unless you can prove otherwise, each joint holder is assumed to own an equal share of the balance. So if a joint account holds $200,000 and there are 2 names on it, Centrelink counts $100,000 as belonging to you, regardless of who actually deposited the money or whose income built that balance over the years. For couples who have genuinely saved together across a lifetime, this 50-50 split is often a fair reflection of reality. But there are 3 specific situations where this default assumption goes badly wrong for seniors. The first situation is when an adult child is added to a parent's bank account. This is an extremely common arrangement, usually set up so the child can help with bill payments or online banking, especially after the loss of a spouse or when health issues make independent banking harder. The intention is purely practical, but Centrelink does not see intention. It sees 2 names on an account, and its default response is to split the balance evenly. In reality, the entire balance may belong to the senior, and the adult child may have contributed nothing at all. But unless that is properly documented, the 50-50 assessment stands. It can even work in reverse, where the adult child's own financial position complicates the assessment for both people. If you find yourself in this situation, contact Centrelink and provide accurate documentation about the true ownership of the funds. A statutory declaration or a written statement outlining the source of the money can support an assessment that reflects reality rather than the default assumption. The second situation is exactly what happened to Helen when a spouse passes away and the joint account stays open. This is one of the most emotionally difficult financial moments a senior can face, and it is rarely explained well. A deceased spouse's share of a joint account does not automatically and immediately transfer to the surviving partner in Centrelink's records. During this transition period, if a new person is added to the account, the assessment effectively resets. Centrelink looks at the current account holders and reapplies the equal share rule. And if that new joint holder has their own financial circumstances, the outcome can be one nobody expected. On top of this, when a spouse passes away, the surviving partner moves from the couple pension rate to the single rate, which changes both the assets test and income test position entirely. If the account details are not updated at the same time, pension calculations can be wrong from the very first fortnight. If you have recently lost a spouse, contact Centrelink straight away to update your relationship status and your asset details, and before adding anyone new to any account, check how that change will affect your pension first. The third situation is when the balance in a joint account does not reflect the actual contributions made by each holder.
Imagine you put $150,000 into a joint account with a sibling, and they contributed $50,000. CenturyLink will still assume an even split of $100,000 each. In this particular example, the default assumption actually works in your favor because CenturyLink is counting less than you truly own. But it works both ways, and if your contribution was smaller than your joint holders, CenturyLink may be counting more as yours than you actually own, inflating your assessable assets and reducing your pension. The default 50-50 rule is just that, a default, and where it does not reflect reality, you have every right to provide documentations,
as bank statements and statutory declarations to support a more accurate assessment. There is another layer to this that connects directly to deeming. Every dollar sitting in a joint account is treated as a financial asset, and every financial asset is subject to CenturyLink's deeming rules, currently 1.25% on the first $64,200 of your financial assets and 3.25% on anything above that threshold. If CenturyLink counts 50% of a joint account as yours, that 50% is deemed, and the assumed income from it counts towards your income test. If that pushes you above the income-free area, your pension reduces again. So a joint account is not just an assets test issue, it flows directly into your deemed income and your income test as well, meaning one account with two names on it can quietly reduce your pension from two directions at once. There is also a risk almost nobody talks about. What happens if your joint account holder runs into financial trouble? If you share an account with an adult child and they face a business failure, a relationship breakdown, or a legal judgment against them, the funds sitting in that joint account can potentially be pursued by their creditors. This has nothing to do with CenturyLink. It is a legal exposure, and it is one that most seniors are never warned about when they add a family member to their account for convenience. So what is the better approach? A financial power of attorney allows you to appoint someone you trust to manage your finances, pay your bills, and make decisions on your behalf without ever being listed as a joint account holder, meaning the money remains clearly yours and the CenturyLink assessment stays simple. A third-party authority offered by most Australian banks allows a trusted person to operate your account without becoming a joint holder, again keeping the assessment clean. And for those who still want a shared
account for everyday expenses, opening a smaller, separate account for that purpose while keeping your main savings in your name only limits your exposure significantly. Here is your action list. Log into MyGov today and check exactly what CenturyLink has on file for your accounts. If you share an account with an adult child, look into whether a power of attorney or third-party authority could achieve the same result without the complications. If you have recently lost a spouse and a joint account remains open, contact CenturyLink immediately and think carefully before adding anyone new. If any joint account balance does not reflect the real contribution split, gather documentation and provide it to CenturyLink. And if your banking arrangements are complex, speak with a financial advisor who specializes in CenturyLink planning. Helen eventually resolved her situation, but it took months of phone calls, a statutory declaration, and a conversation with a financial advisor to restructure the account properly. None of that stress needed to happen if someone had explained these rules to her beforehand, and that is exactly why this channel exists. If this video helped you, please hit the like button. It genuinely helps more Australian seniors find this information. Subscribe to Australia Pension Hub for ongoing updates on pension rules and CenturyLink changes, and let me know in the comments whether you knew CenturyLink assessed joint accounts this way before watching. Share this with anyone you know who holds a joint account and receives the pension, because it could save them from exactly what happened to Helen. I will see you in the next one.